Good afternoon, everyone, and thanks so much for spending the time with me today to review the fourth quarter 2018 MTI quarterly forecast report. We've got quite a bit of content that I want to cover over the next 30 minutes or so, uh, but the summary of it is we have an updated outlook for both MTI average monthly sales and for the broader macroeconomy. We have enough evidence now in the data streams that are coming in that points to the fact that the tax package, the reforms that the administration passed in late 2017 are really having a positive effect on the economy. We have extended our outlook for the cyclical rising trend to continue for an additional 6 months or so into the early part of next year. We still remain committed to that cyclical peak that I've been telling you about. We just think that the short term kind of boost in the arm to the economy that the administration provided with tax reforms, we now have credible evidence of that. And so we wanted to reflect the current macroeconomic environment by revising upward both the macroeconomic outlook and the forecast for MTI members. Keep in mind that as economists, any forecast that we generate is really born to die. We create our forecasts with the best assumptions available to us at the time, and the MTI forecast for the average monthly sales has actually been in place for nearly 2 years now, way before anyone ever even thought about a tax reform deal or anything like that that could be possible. So we didn't want to jump the gun and upward revise our economic outlook and the MTI forecast before we had that credible, tangible evidence available. We now have that with very, very strong data coming out for the summer months and certainly into the early part of fall. And we felt compelled to issue an lift, upward revision to the forecasts. So to review that in a little bit more detail by looking at the specific MTI numbers, I wanted to highlight to you the data that was coming in and point out a couple of very interesting observations. So here you can see this is the reported average monthly sales data for MTI members for the past 12 months. You can see that the fact that this is green here means that it has been in a consistent, prolonged period of accelerating rise, basically over the last year and even slightly before that. We were expecting that there would be a peak in the mid to third quarter 2018 timeframe, and we kind of saw a tentative peak develop. What I mean by that is if you look at these rates of change, you look at the 312, which is your quarter over quarter growth, you can see it was rising. It eventually hit a peak of 13.6% here back in the May timeframe, and then started to decelerate as we were expecting and actually decline in June, in July, and August. But in September, we saw another uptick back to 13%. Same thing can be said for the 12/12 rate of change, which is the the year over year growth rate. We had a rising trend as we expected. That number peaked originally at 11.2%. It started to decline with the August data, but then shot back up with the September data. And this is really indicative of broader signals that we're receiving from the bigger economic picture. Industrial production, business to business activity, and certainly new orders for capital equipment are all behaving in a very similar profile. So what we've done is we have issued an upward revision to the forecast. As you can see, we expect that accelerating growth trend to persist for 2 more quarters. So in both the fourth quarter of this year and into the first quarter of next year, at which point we will still have that transition to the backside of the business cycle. We're going to have a period of slowing growth, and a mild contraction is still expected for the early 2020 timeframe, which is also about 6 months later than we originally had been expecting a contraction for your industry. So essentially, the profile of our forecast has not changed, neither for MTI average monthly sales, nor for the overall macroeconomy. It has just been delayed or pushed out by about 2 quarters, or roughly 6 months or so, because of the boost that the economy has received from the tax reform package. But in order to explore that in a little bit more detail, I wanted to spend the majority of our time together looking at some of these big macroeconomic trends that we're noticing right now. So I'm going to shift to sharing that screen with you. Give me just 1 second while I do that. Okay, so you should all be looking now at the title slide of the November 2018 webinar for MTI members. I thought I'd start off by looking at the macroeconomic trends in general, and of course, the best benchmark for the macroeconomy for MTI members is going to be U.S. industrial production rather than GDP, because you are largely exposed to the heavier industrial side of the U.S. economy and not so much to consumer spending, which comprises about two-thirds of overall GDP. So we've always argued, and we have seen a great correlation between this representation of U.S. economic activity, the industrial production index, essentially sort of as a benchmark of what you can expect in your own industry. And what we're seeing right now is a very unusual type of situation. The length of rise that we've seen since that mid 2016 low is now approaching record territory. So we are beyond what is normal for a typical duration of economic rise in the United States. Typically, we're looking at about 12 to 18 months of accelerating growth. We're now beyond that. And if we get into January, it will be a record long growth streak for the U.S. economy going back many, many years. So on the one hand, that's a really good thing. It's obviously showing that some of the policies of the administration that have been pro-business, such as the tax reform package, are working. And we, as I mentioned earlier, have adjusted our outlook based on the latest available data and the latest assumptions that we're making, considering what we see now in the strength for the July, August, and September data that's come out. You can see that right now, year-over-year growth for the U.S. Industrial Production Index stands at 3.8%. We do expect a slight uptick to 3.9% by the time 2018 is all said and done. But similar to what I had been talking to you about for quite some time now, we are calling for that crest in the wave, that peak in the U.S. Industrial Production Index to occur in early 2019. We will have a transition to the backside of the business cycle, and eventually that will give way to some mild negativity. The main adjustment that we've made is not to the amplitudes or the profile of our forecast, either for MTI member companies or for the general industrial economy, but rather to the timing of it. So we have evidence also that artificial boost to the arm from tax reform is not going to last. I'll show you some of that evidence in just a few minutes, but we still remain committed that the business cycle will peak and there is a period of slowing growth in our near-term future. That forecast essentially calls for relatively flat performances in both 2019 and 2020, but understand that between these two periods in time, between the end of 2019 and between the end of 2020, there will be a couple of quarters of contraction, negative performance year over year, both in the macroeconomy as represented by the U.S. Industrial Production Index and for MTI member companies, as you will have seen in the forecast in your latest MTI market forecast report. We do expect that negativity to be brief and mild, and it's going to turn around. And by the time we get into that latter part of 2020 and certainly into 2021, we'll be back up into positive growth territory. So think about 2019 and the first half of 2020 as perhaps a chance to catch your breath a little bit, a chance to think about the next rising trend in your business, to prepare, make sure you've got the right people, the right capacity, the right things in place to leverage that next rising trend that is coming in the second half of 2020 and into 2021. So if I were to compare the two forecasts to make it very easy for you to tell what's going on visually, the orange dots here represent our old outlook. The blue dots represent our new outlook. And as you can see, the profile, again, the shape of the forecast on a rate of change basis has not been altered dramatically, other than a little bit more pessimistic outlook when we get out into the latter part of the forecast, into 23 and perhaps into 2024. But for now, for at least the next 3 years, it's just expected to peak a bit later than we originally thought, and then that low will also happen by about 6 months later than earlier. But generally speaking, from a business decision-making perspective, from a planning perspective, it really doesn't change the type of action and the type of decisions that you should all be making in light of what we expect for the macroeconomy. Taking a look at the the tax reform package in a little bit more detail, I think is important because you have to understand what is it that's driving this uptick in growth that we're experiencing right now. And I can certainly make the argument that it is not the changes to the tax rates themselves that's driving this. In this particular slide, I'm showing you the relationship between CapEx and the corporate tax rate. So the blue line here represents the average corporate tax rate in America during the last 50 or so years. And the orange line represents the percentage of our GDP that is made up by gross business investment. So there's a couple of takeaways that I want you to have here. First, understand that between 1960 and 1986, the average tax rate in America was the official tax rate for corporations was 48%. Then we had the Reagan administration pass some substantial tax reform in 1986, and the corporate tax rate on average dropped to 35%. And of course, here, this drop off, you can see that's the latest iteration of tax reform when we changed corporate tax rates from 35% down to 21%. But keep in mind, the official tax rate is not really all that important, because what is really important, in my opinion, is the effective tax rate, meaning what kind of taxes are corporations actually paying. And if you look at the last couple of decades, the effective tax rate in America has been much lower than the official tax rate because there existed many deductions and loopholes and write-offs for corporations to use that lowered its actual effective tax rate. So evidence points to an effective tax rate somewhere between 10 and 20% actually over the last couple of decades. So it's first of all possible to think about corporate tax reform as actually resulting in higher tax payments for some corporations, because part of the tax reform bill was also the removal of many of these write-offs and deductions and ways to minimize the amount of taxes that companies were paying. So yes, we have a lower official corporate tax rate, but the effective tax rate for some companies might actually be higher. But the key takeaway here, in my opinion, is the fact that if you look at those two lines, there really seems to be no correlation between the percentage of our economy that is represented by gross business investment and what the actual corporate tax rate in America is. So back here, you can see when it was averaging 48%, on average, gross business investment was roughly between 10 and 13% of GDP. When we lowered it to 35%, it remained very much in that range, between 10 and 13% of GDP, the actual number being somewhere between 12 and 13%. So the reality is there doesn't seem to be any historical evidence that lowering corporate tax rates actually creates opportunities for business or stimulates business investment. And there's was a survey conducted by the Atlanta Federal Reserve that shows that only about 10% of all corporations in the United States plan to increase their CapEx by 15% or more as a result of corporate tax rates. So most companies are not looking to leverage changes in corporate taxation as a significant boost to the investment. They're certainly not going to be doing the type of things that stimulate economic growth. Because what corporations love to do is they love to leverage that capital to buy back their own stock and to pay out more dividends. In this particular chart, you can see that the S&P 500 buybacks over the last couple of quarters have really shot up significantly and stand near the same level as they were back in late 2013 and early 2014. So corporations are not doing the type of actions that really stimulate the economic growth needle. They're not buying more new equipment. They're not hiring a lot more people. They're not expanding production capacity. They're leveraging all of that additional cash to buy back their own stock and to pay out more dividends, which at the end of the day does not stimulate the economy. What I do think stimulates the economy is a different part of the tax reform bill, namely the accelerated depreciation provision. So what this did is, as of the end of last year, companies can now write off 100% of any new or used asset purchase within the first year of purchasing that particular asset. And that's a pretty significant change, because prior to that, you could only write off 50% of a new asset. Used assets weren't covered. And so I really do believe that this is creating some additional momentum in the business to business world, in the orders for new capital equipment. And you can really see that showing up in our benchmark series that represents business to business activity, which is non-defense capital goods new orders without aircraft. So I'm showing you that particular series here. On the top, what you're looking at are the rates of change. The green line represents the year-over-year growth rate, and the gray line, the 312, that is the quarter-over-quarter growth rate. You can see that the gray line has already peaked. It has now fallen below the green line, which of course under ITR methodology is a checking point that suggests that slowing growth is going to occur over the next 3 to 6 months. So this is basically talking about the fact that the peak in business investment, as represented by CapEx, as represented by new orders, is already taking place right now. Okay, and one of the other reasons why we think that this is indicative of a peak is when you look at profitability from a corporate perspective and look at the developments over the last 3 quarters. It's really been quite a remarkable picture of more and more companies in the S&P 500 issuing negative EPS guidance. What that basically says is they're saying, although my business is strong today, my expectations for future profits are lower than they were in the past. And you can see the third quarter 2018 numbers right here. More than 75% of all companies actually expected to have lower profits in the future than they did up to this point in time, which of course will translate to lower levels of investment on those companies, lower levels of CapEx. When you combine this with the fact that a lot of CapEx is driven by lending, by borrowing money and then using that money to buy new equipment and new plants and add capacity, then the interest rate environment we're in right now is also saying it's going to become less likely that companies are going to invest, because we are expecting further hikes in the Federal Reserve's policy and in interest rates. We're expecting at least a few more hikes over the next 12 months, which will make, of course, somebody else's money more expensive, make it less likely that companies will continue to borrow at levels they have been in order to facilitate further growth. So we have several pieces of evidence now that point fairly consistently to a slowing economy as we get into the 2019 timeframe. If we look at this from a very basic level, what I'm trying to communicate to you is that this is where we've been in 2018 and certainly the second half of 2017 before that. We have been in by far the best phase of the economic cycle in the United States. The economy has been a tailwind for you, but we are nearing this crest. It's going to happen over the next 3 to 6 months, at which point we will start to transition. And by the time we get into the latter part of 2019, certainly we're going to be in a period of slowing growth. This is a cautionary phase. My best advice to you here is really don't get ahead of yourself. Understand that the cycle doesn't lie. It always transitions through these peaks and these lows, and the peak is coming. We already see substantial evidence of slowdown abroad, meaning outside of the United States, places like Europe and China, and global manufacturing indicators like JP Morgan's indicator is certainly suggesting that it's going to continue to slow. And all of that is taken in context with one of the major risk factors that we see in the U.S. economy right now, which is, of course, the current policy of the administration to deal with what is perceived as unfair trade practices by many of our trade partners in implementing tariffs. So I wanted to show you this to give you an idea of what is currently in place, and on top of that, what is still potentially going to come down the line. So on the bottom here, you can see these are the tariffs that the U.S. has already enacted as of 2018. We have about $1.8 billion worth of washing machines that are under tariff. We have steel and aluminum that's under tariff, and solar panels, $8.5 billion worth of solar panels. On top of all of that, we have now implemented about $250 billion worth of products coming from China. We have now put tariffs on top of that. $50 billion worth have a 25% percent tariff in place right now. The remaining 200 billion, which went into effect on September 24th, currently have a 10% tariff in place, but that is expected to rise to a 25% tariff starting in January of next year. But the president has come out and said he's considering tariffs on an additional $267 billion worth of Chinese goods. And that means that, certainly if the Chinese don't give us the type of concessions that we're hoping to receive from them, this is very much on the table. And on top of that, we also have a totally separate consideration for more than $350 billion worth of automotive related tariffs, both on new vehicles and on automotive parts. That then this is really critical because the automotive sector is actually a meaningful industry in the United States. It's a sizable chunk of the economy, and the automotive trade bodies are saying are very concerned that this is being considered because they've done their own studies, and of course you have to take those with a bit of a grain of salt. But they've shown that if these tariffs do in fact go into place, the average price of a new car in the United States will increase from $35,000 where it is today to about $40,000. And the reason why that's so important is that demand is elastic. That means that if prices for things go up, then demand for those products tends to go down. So they're already kind of struggling to keep up, the level of sales that they've been used to. Industry pundits talk about peak auto, which means that we really have at roughly 17.5 million cars that are produced every year. That's kind of the peak of what the industry is going to see. And they're really concerned that if we go forward with these tariffs, it's going to mean a substantial decline in industry performance during a time when they obviously are already facing some headwinds. So my biggest X factor when I talk about the economy next year is how does the administration treat these tariffs as we move forward. We obviously had the election last night. The House got flipped to the Democrats. It'll be very interesting to me to see how they interplay with the administration. What happens to tariffs at this point? Does the president recognize some of the achievements that he's made in terms of getting the USMCA ratified instead of NAFTA, in terms of getting a new trade deal set up with South Korea? I know that they're currently in talks with the Europeans and with the Japanese. The Chinese government has indicated that they do want to negotiate, but the president said that we're not quite ready for that process to begin yet. I think his goal is to make them feel a little bit more pain so that we can have a stronger negotiating position when those talks actually start. But this, in my mind, is the big X factor, is what happens with tariff activity moving forward, and does it actually increase in its tenacity, meaning that could we have more negativity in the economy as a result of that development as we get into that late 2019, early 2020 timeframe, or do we actually, pull back in some of our tariffs, and that will actually have a more robust positive performance on the economy? So there's still a lot of moving parts here. We're paying very close attention to those developments, and there are other developments related to those that I'm recommending that you pay careful attention to as we head into next year. So tariffs and trade are all fine and well, and I think that the administration is really fulfilling some promises that were made during the election campaign of 2016 with their current actions. But there are, as always with anything economic, there's the unintended consequences. So right now we're already starting to see inflationary pressures start to build. There have been many very well-known brand name companies that have come out and said we are having to raise our prices because of the tariff situation that we're in. The latest one was Caterpillar. Just on their latest third quarter call, they said that they're having to increase prices on their equipment by double-digit rates because of the steel and aluminum tariffs that are in place right now. With that comes the almost assured behavior of the Federal Reserve Board, because they have two distinct goals. Number one is full employment in the economy. Number two is keeping a lid on inflationary pressures. And the way that they do that is by rising interest rates. When they raise interest rates, that puts a downside pressure on inflation. And so, despite the president's objection to the Fed in terms of the pace at which they're raising the rates, if we continue to see inflationary pressures mount the way that we expect, then we are almost guaranteed to see further hikes in our interest rates. So a lot of things to pay attention to as we head into next year. Make sure that you understand that any slowdown in the economy and in your own business is actually probably healthy at this point, given the length and the amplitude of rise that we've seen in the economy. We need a chance to catch our breath a little bit. We need the chance to strategize, to think about how do we prepare our industry and our businesses for that next rising trend that's coming in 2019 or in 2020 and beyond that. And keep in mind, even if it does become a mild recession in the U.S. industrial economy by the early 2020 timeframe, at the end of the day, recessions really represent opportunities. If you know that they're coming and you can plan accordingly, you can have a strategy going into it, then you can actually leverage other people's pessimism during those downturns to take advantage and be profitable and really get assets and all sorts of type of investments for a discount during that period of time. So understand what to keep an eye on. Understand that it's going to be relatively mild based on the information we see right now, but certainly could become more profound if we intensify the trade dispute, primarily with China. Understand that pricing is critical. You have to look for every opportunity to increase prices to keep up with these inflationary pressures, because at the end of the day, you're not in business just to grow your top line. You're in business to protect your profitability and to grow your margins. And so you have to think about charging your prices in a totally different light. It can no longer be a once a year or once every 6 month kind of conversation. You have to know where each one of your customers stands from a profitability perspective. And if they're not where you need them to be, then you have to be prepared to have that tough conversation with them and say, this is what I have to do in order to remain, in order to achieve the profitability goals that I have. And I need you to work with me to help me achieve that. So these are all things that you should pay attention to as we head into 2019 and beyond. I think that to kind of wrap things up, I wanted to go back to the forecast report for just a second and show you our forecast expectations for the 12 quarters into the future. So you can see again, through the next 6 months, we remain steadfast in our expectations that double-digit growth will continue. By the second quarter of 2019, we will transition to a slowing period of growth for MTI average monthly sales. That will extend into the early part of 2020 and eventually give way to some mild negativity. That will be very brief, and you will see a turnaround into more positive growth by the time you get into the late 2020 and early 2021 forecast. So with that, we've come to the end of the webinar. I certainly am happy to answer any questions that you may have. Feel free to reach out either to Tom or to myself. You can contact me through the itreconomics.com website or reach me on my email, which is achosovsky, and that's spelled ACHAUSOVSKY at itreconomics.com. Guys, thank you so much for your time this afternoon, and I hope you all have a wonderful day. Take care.